The market says, hey, inflation is already coming down. Well, it is. That's actually true. Inflation peaked on a year-over-year basis. Monthly report calculated year-over-year was 9.1% in June, but it's come down to from the high eights, mid eights, low eights, 7.7, 7.1. Now, 7.1 is still high. Don't get me wrong. Inflation is still high, too high. I buy gas and shop for groceries just like everybody else, so it's still too high. But it has come down from 9.1% to 7.1% in the last 5 months. And so the market says, hey, you did it. You're already there. Inflation is coming down. Why don't you stop? And by the way, you're going to get the memo, maybe in February or sometime soon, you're going to get the message. The economy is going to be slowing down. Inflation is going to be coming down. You're going to hit the pause button early, meaning maybe as early as February. And then you're going to cut rates. This is the famous pivot. Whenever you hear of the Fed pivot, that's when the Fed turns around and starts cutting rates instead of raising them. And that'll be just in time, and growth will slow, but it won't be too bad. And we'll come in for a soft landing. And this is the Goldilocks scenario. So again, typical Wall Street, get the pom-poms out. The Fed's going to cut rates by March, and so buy stocks. That's all Wall Street knows, is buy stocks. So that's Wall Street's version. So there's the Powell plan and then Wall Street's version. Here's the reality. There is a chance that we are already at the terminal rate. But the conundrum is inflation coming down because the Fed is still hiking, or is the inflation coming down because they're at the terminal rate? Well, we don't know. It's kind of hard to sort those things out. Powell would say, yeah, it's coming down. I know that, of course, but it's because I'm hiking and I'm going to keep doing it. My view is, no, you actually did it. It's mission accomplished. You just don't know it. You're fighting. You're like the Japanese in the caves fighting 4 years after the end of World War II. I mean, you're still raising rates and you already got to where you want to go. You're going to throw this economy into a very deep recession because you're going to go too far, as usual, and you're not going to know it until too late. By the time you realize it's mission accomplished, you will have gone too far, too long. Rates are going to be too high, and it's not going to be a soft landing. If Wall Street's talking up the stock market based on the soft landing Goldilocks scenario, Powell's going to stick to his guns and raise rates too high. That's going to cause stocks to crash very severely, very suddenly. Warning people what's going to happen, they're not listening, and it is going to happen. So markets will crash. So lighten up your equity exposure. I'm not saying sell every single stock. There's room for a slice of stocks. I would, for the stock portion of your portfolio, I would look at energy, like companies like the obvious names, Chevron, BP, ExxonMobil, Marathon, because they have refining capacity. We're not getting away from oil and natural gas, in my lifetime, probably not in this century. The whole, I got nothing against solar power and windmills, but if you think you can run a modern power grid on that, you know nothing about physics, you know nothing about the baseline power needed to maintain a power grid. 10, 5 or 2-year notes, treasury notes, not junk bonds, the treasury notes in your portfolio. I have a big slice of cash, maybe as much as 30%. People say, I hate cash because it has no yield. Well, first of all, if we have deflation, cash could be your best performing asset because the real value of money goes up, not down. It goes down in inflation, but it goes up in deflation. But cash also has embedded optionality, meaning if things are crashing and burning all around you, the person with cash who's not stuck in the wrong asset class can go shopping. You can pick up the bargains. And by the way, the biggest cash hoard in the world right now is probably Warren Buffett at Berkshire Hathaway. He has $130 billion in cash. Why? Because he sees what I see. He sees what we're talking about. The wreck is coming, and again, you get to go shopping. Yeah, I mean, just every day, Target, Amazon, FedEx. Today, Goldman Sachs firing 5,000 employees. Twitter, thousands of layoffs. I know they're individual cases, but Amazon, same thing. They add up, and then not to mention when you get into recession, which is coming, all the small businesses that sadly just fail and lay off everybody. And by the way, unemployment is a lagging indicator. People go, well, there's no recession because unemployment is not going up enough. No, unemployment is a lagging indicator. When you're in financial distress, you cut all your costs, you turn out the lights, you do a lot of things first. The last thing you want to do is lay people off.